meetings. Is it recording? Okay. We are meeting here today with the property and casualty people to discuss Lewis and Clark County's renewal of our property casualty. This is just property casualty.
Correct, yes.
Okay. And let's start off by, we will go around the table and get our names on the record.
My name is Hope Barker and I'm with MACo. I am the Property Casualty Trust Administrator.
I'm Kevin McCutcheon with Marshall McLennan Agency, and we are the agent.
Judy Sauer, also with Marshall McLennan Agency.
Frank Cornwell, County CFO.
Tom Roth, Commission.
Candace Payne, Chair of the Commission. Before we go any further, Mr. McCutcheon, where are you based out of? Are you from Helena? Or,
yep.
Okay.
Yep.
And the name of your agency is Marsh
McLennan Agency, yes.
Used to be Payne West.
Used to be Payne West Insurance. Yes.
Marsh is buying out everybody.
Payne is such a good name.
Yeah, it is a good one.
That's why I just didn't even, I couldn't compute where this was coming from. Oh, Payne West. All right.
Yes, and we still actually say that a lot ourselves.
Yeah. You're not the only ones.
Yeah, it doesn't.
Okay, well, turn this over to you, Hope.
Great.
And lead us down the path.
Beautiful. All right, we can quickly review the agenda here. So we'll start off with the benefits of pooling, and then I have 2 pages on our excess and reinsurance market analysis, which basically describes why we're seeing rates trending the way that they are for both property and casualty insurance as a nation. And then I hate it when people give these presentations and wait until the very last page to talk about money. So we're going to dive right into that right away with the 2025-2026 contributions and previous year comparisons. And then we have our property and liability coverage in our claims review, which is part of the modification factor that is used to determine what we use to determine what the rates are with our actuary. And then we have our last page is the risk management services and contact information. And then the property acknowledgement form, which I believe you have already signed. So you should be good to go there, and discussion. But please discuss as we move through this. This is a lot less painful if this is more of a conversation versus me just tacking at you. Then we go to the next page, the benefits of pooling and why MACo. Stability, savings, coverage, and member driven. Stability and savings kind of go hand in hand. Private insurers are pressured to provide short-term results to investors. You are MACo's priority, and this allows the PCT Risk Management Authority to maintain stable rates even through volatile times. So there's never going to be a point, even if you have a catastrophic loss and have a 3,000% loss ratio, where I come to you and say, so sorry, but you weren't as profitable to the trust, so good luck to you out in the market. That's part of the benefits of being with the pool, that no matter what your losses are, we make sure the pool is in a healthy spot so we are able to continue covering those claims. With that being said, that is not the case for MACo. We had a claim that had come through for special districts that we've determined there's no coverage for. However, they like to think that there is, so they have filed with our county litigation group, and our reinsurance found out about it, and we were potentially not going to be as profitable to them. So they threatened to drop us.
Can I ask which of the special districts it was?
It was 3 county. It was the irrigation district.
Thank you.
Yes. So I was gonna say, I'm like, I don't remember which county it was because one of them dropped out, one of them was considering dropping out, but it was 3 counties.
But it's the irrigation district, not
correct.
the county. Okay.
Yes, it's the irrigation district. And so our reinsurance found out about it and threatened to drop us. We've been with them for a very long time, so our rate with them is just under $1 million. But with that being said, we had to go out and look for a second best option. And our next best option was $4.2 million. So there is never going to be a point where we come to you and say, so sorry, but you're going to have a 75% rate increase because our reinsurance tripled. we make sure that our pool is in a healthy spot so that we're able to take the brunt of that, and then your rate stays stable and you're not seeing a significant increase because of something like that, as well as being able to handle the claims that are anticipated to come throughout the year for all of the counties. Then MACo works closely with our actuary to keep contributions low while still maintaining the health of the pool. Excess funds are, quote, returned to the members by investing in proper management. So we're not necessarily writing refund checks every year, but we are making sure that we're investing properly so that way we're not losing anything on inflation, etc. And coverage, we want to cover your claims. Private insurance carriers will find the smallest excuse to deny coverage. One quick example I'll use is we had a county that did not know that they owned this parcel of land. There was a small shack on there, and they found out that they owned this parcel of land when the shack was hit by lightning. And they discovered that there was a $75,000 pump inside of said shack. So we were able to determine that our appraisers never knew that they owned it and found it. They did not know ever. There was no record that that had taken it off the schedule to try and save money on premium or anything along those lines. It was just an accident. If they would have been out in the open market, they just would have been SOL and would have had to come out of pocket the $75,000. However, what we were able to do is determine, okay, if this was on the schedule, how much would it have cost the annual premium, which was about $250. And then how much is the deductible for this type of claim, which was $2,000. So instead of charging them $75,000 to get this fixed, they only had to pay $2,250. So one of the benefits, we use Title 33 as a guideline to make sure that our policy is kosher with the rest of the state laws. However, we are not required by the insurance commissioner to follow Title 33. And then we are member driven. So MACo members are our top priority, and we provide risk management services to help with litigation defense, human resource assistance, land use guidance, finance guidance, and public safety risk management assessment, which I have contact information on the very last page. So you can dive to the next one. And here we have the reinsurance market that I had mentioned. So the first one is our 2024 catastrophic losses, and this is on the property side. So from 1980 up until about 2020, we had 8 catastrophic losses that cost an average of $64 billion. Within the last 5 years, that has increased to 24 events and has cost the nation $151 billion.
Question.
Shoot.
I guess I was thinking that when you say our, that you're talking about MACo. But according to this sheet, this looks like it's probably Gallagher.
So it's Gallagher, but it's for the nation as a whole to why all of us are seeing rate increases. So it's not just MACo that's seeing the rate increases, it's any insurance company, open carrier, pool market, etc. So Gallagher does it for multiple different pools. They have Missoula, they have, municipal airport authorities, etc. And so they're able to kind of calculate as a whole what the nation is seeing and why we're seeing those rates increase.
What this map is or the picture is basically look at it from a reinsurance standpoint. So when insurance companies, even your risk retention group, you go out and you buy reinsurance to drop down over the top. All these carriers do it too. So say you're just talking about Travelers Insurance or Liberty or any of those commercials you see all the time. They still buy reinsurance to go over top of their catastrophic losses. So what you're seeing is what the different multi-billion-dollar storms that have happened across from a property perspective. That's what that map shows. So it's looking at it beyond just the municipality space or the any special district space, any of that stuff. This is looking at the property market as a whole across the country.
And
that helps.
That makes sense.
When I look at it, which next year we'll see the fires over on the West Coast, and we do have risk for fire as well as some of those winter storms. But when I originally looked at it, okay, well, none of this is in Montana, so why does this affect us? And it's the same way that we look at the counties and the cities. So you might not have a claim specifically in Helena, but if it is in Lewis and Clark County, it's going to affect the county's premium the same way the states affect the nation's premium. So cities versus counties, states versus nation. So it made it a little bit more digestible when I was able to look at it from that perspective, if that makes sense. Did we have any more questions here? No? Okay, we can dive into the next
Okay, I
one.
got a question for you.
Shoot.
So what happens if, say, a county pool doesn't have umbrella coverage in an instance? Has that ever come back to haunt us?
It could potentially, so if we just had no reinsurance, then it would come back to haunt us if we had a catastrophic loss and our pool wasn't in a place to where we could handle that type of hit, basically.
Okay.
But we would basically have to run out of money for that to hit us.
We did, in the past, MACo didn't have reinsurance for about 3 years.
Okay.
And that's when the lady got murdered down in
Oh, what nice timing.
Clancy.
Mhm.
She died. Police from Lewis and Clark County, Jefferson County, and one other county tracked the people down, arrested. They were sent to prison for 20 years. And then the
You're talking about the wrongful
Incarceration.
incarceration claim.
Yep.
Yeah.
and they figured it out because of science.
Mhm.
But as a cost-saving measure, the MACo didn't have umbrella insurance for several years. They have it again now.
Yes.
But it's really
So your
expensive.
pool paid that claim, the whole pool,
Yeah, the whole
took the
pool
money
came
from the
together.
pool to pay that.
But it was to, save penny wise and pound foolish, I think. is, That's what I know about that.
Yes, and that was before me, so I've known about the wrongful incarceration claims, thankfully, I was not involved in them. They settled it before I got in here, so I got to avoid that mess a little bit, but, something like that could absolutely hit the trust, and depending, so if it came back in a year that there wasn't insurance, then, or reinsurance, then it would 100% come out of the trust, and we would not have our reinsurance available to kick in and assist on that. So that's always a possibility if it came in from a year that wasn't, because even the one with the irrigation district, so even if they would have dropped us, they still would have had to pay for it because they were the ones that provided coverage for that year. So we might not have them moving forward, but they would still be the ones that were helping us or assisting in whatever manner on those years that we had those.
That's good to know. Thank you.
Yes. So next page, this is on our liability side. So why aren't we seeing more rate relief here? All of these blue boxes are the basic reasons as to why, but if you jump all the way to the left side, the increasing propensity to sue is the biggest reason. With that, the size of the jury awards have significantly increased. So what payouts used to go for $100,000, they're now paying out for $1 million. So that's jumped up significantly. But on top of that, courts and juries are favoring plaintiffs. They're basically tugging at their heartstrings, and people are making decisions based off emotions instead of just simply based off of the facts that are in front of them. So that then goes hand in hand with the size of the jury award and wanting to award more money with that. And then we jump into the most frustrating part, but the growing distrust of large corporations and litigation financing. So private equity groups are coming in and are funding litigation. And on average, we are seeing a 20% return on investment. So, and I had even heard through the grapevine that there was potentially a class action lawsuit, and there were going to be 30 to 40 people that partook in that. Well, then private equity backed out of funding that for whatever reason, whether it be because it just was not profitable enough, they didn't have enough evidence, etc. And it dropped down to 3 people that were interested in continuing to pursue this class action. So if you're going to pay for my attorney fees, then sure, I'll put in the work and go to trial, etc., and see if we can't get some money. But if I have to invest my own funds, then I'm not interested. So that's frustrating, but then that does lead to the aggressive plaintiff bar ads and changes in regulatory and legal environment bar ads. Do we have any questions there besides frustrations?
Do you know I was gonna look this up, but a few states have they have laws around litigation financing. I thought Montana was one that had something maybe pending on that, but
Not to my
I don't know if you've
knowledge.
heard anything on that front, but that is around the country, that's one of the bigger challenges that we're talking a lot about, is that private equity entering into the litigation space. Something we just really hadn't, minus past 5-6 years, we really hadn't seen that as a concept. But as the private equity movement's grown significantly over years and acquisitions and all these different things, we're seeing that as a crazy national trend that we have to be paying attention to. But it also would be a advantageous side from a legal perspective if we have some laws set around those types of things. But I thought Montana was looking into one. I just don't know the results of that. So.
Nope, I have not heard anything about that.
Montana has a cap on the amount of damages
Yeah.
that
Mhm.
governments can be forced to pay, which is why people file in federal court.
Correct,
Yeah.
750, 1.5.
Yeah, I just didn't know if what our stance was at this moment on the private equity side of financing litigation. So yes, we have some of those good public entity caps, which have held pretty well. I think some other states have not held great on that front, but it's a different animal when you get into some of those privately funded.
Is that all they do? It's just private equity firms that just do litigation? That's it? Oh, that's fantastic. And you're literally, yeah, and there's people investing in them doing, like, go after it, and that's what they're charged to do.
Yeah,
Kind of almost creates the churn.
Yeah.
That's fun.
well, that's why it's hard when I say a 20% return on investment, like,
That's crazy.
yeah, I don't know if I could,
We'd all take it, but.
yeah, in good moral, consider this an ROI. Next page, flip over. So this is our renewal comparison. So you look down at the bottom and you guys are looking at a 16.47 increase this year. However, we had voted for a 2% increase for inflation, a 4% for property, and a 5% for liability. So overall, the pool's average increase this year for their base rate is 11%. So you guys are just over that, about 5% there. But if you go up and look at the top here, buildings and contents, you had an increase of 1.75 million in total insured value. Vehicles, you had an increase of 1.97 million. And equipment, you had an increase of $124,000. So in total, we're looking at an increase of total insured property of 3.84 million, which is a pretty decent sized jump there. But I look at this and say, okay, well, how can we save money? One of the biggest things that I've seen here is over on the vehicles. And I've had some talk about cutting coverage, and this is not cutting coverage, but one of the things that we do is if there is a total loss of a vehicle, we pay out on actual cash value at the time of the loss. So if you bought a new pickup for the county 5 years ago and it was $75,000, now today it's got 200,000 miles on it and it's probably not worth $75,000. But if you've left it at that value for $75,000 up until now, then we're overpaying in premium. And it's basically death by 1,000 cuts with that. So we, as they're turned in, usually like to go through Price Digest. And so if you bought a used vehicle, we'll double check and make sure that the value is accurate with what is the stated value that's been reported. But usually what happens is the agent will send out the schedules, commissioners or whoever receives them turns them out to the different heads of the departments. But if they're not making those adjustments to the values, your agent can't update these. So I had one agent that she had taken over the account. I don't know how long you've had this account, but for this particular situation, I just want to drive home how big of a difference this can make. They had over 115 changes. They had updated since this agent had taken over about 5 years ago. But prior to that, she assumed that the agent before her handled the account the way that she had. and was adjusting those values. And even the foreman had like 3 pickups on there that he hadn't seen in 5 or 6 years. So sometimes they can just accidentally get left on there if they weren't updated to take that off of the schedule when it was traded in, purchased, and purchased a new vehicle, etc. But they ended up having a 10% decrease from what they were going to pay based off of just those changes with vehicles. And then I had an agent kind of buck back that it wouldn't make that big of a difference last week. And hello,
Hi, Roger.
here's this for you.
You're welcome.
And with that, the first 3 vehicles that we looked at, they were overinsured by $35,000 just on 3 vehicles. So that's, depending on what you're purchasing, that could be a new vehicle. So something to think about there when trying to cut on costs there.
Quick note on some of that stuff.
Mhm.
I think we have made some adjustments over time on some of those vehicle lists because I was looking through this actually and spot checking a few different ones throughout. So there's an occasional 1 or 2 that we'll run into, like, give you an example. We've got a 2022 Dodge Ram 3500. You have it at $74,379. That vehicle range, when you look it up, is if you look at going to buy a similar vehicle. Now, I don't know the miles you have on yours, but that similar range would be between $56,000 and $71,000. So at the high end, you're not very far off. But if we're talking closer to the lower end or it has a lot of miles on it, there's $20,000 on a vehicle right there. But there's a number of them I can tell that have been adjusted down just over time, because we can see that you've got like let's see, just looking at that, you got a 04 GMC 1500, you have it at $12,000. That might be a little bit high, but it's probably not horribly off from what you could.
Who determines the value of our fleet
I was
vehicles?
gonna ask the same question.
We don't know.
I thought it was MACo that would go in and.
We will double check them as they're reported. So like the last year as they've been reported, then it's usually whoever reports it to the agent, and then the agent reports it to us. So but you can go, so like the heads of the department is oftentimes
Jenny
who
Chambers.
does it.
Sheriff's office.
Yeah.
Some of this has to have been adjusted because you wouldn't, even in 04, you couldn't buy a GMC pickup for $12,000.
Yeah.
Yeah,
So you would adjust
Yeah.
it down. So
Which is great.
But there are a few that I think are worth kind of having a little further discussion on to see if the delta has moved enough on it to maybe adjust something like that. I mean, we do have 100 and.
Pretty big. You guys have a pretty significant fleet. I want to say it was like
It's vehicles and
61,
trailers, but yeah, you're almost 200 vehicles and trailers. Trailers, in some cases, some of your trailers actually have pretty high values, but most of the trailers are not really the driver of this. It's just more vehicle costs on a certain cases. But
What about the sheriff's mobile command vehicle? Yes, is that valued at?
I don't think it's on.
So law
not
enforcement
covered
is
by
a little bit different. So the vehicle of law enforcement, that will be paid out on actual cash value. However, any equipment that is in it is replacement value. So we're not gonna, if you have a total loss of vehicle, we're not gonna say, go to auction and find a new light bar. We'll replace that at value, to buy new for those vehicles.
We have a mobile command vehicle that's $1 million. It has it's like a mobile office.
Okay.
So
I'm not sure if it's on this. It's insured. I'm just not sure if it's on.
This or
Chairman,
equipment.
I apologize for interrupting the meeting and joining you late. So, do we have an agenda for this meeting? And did we post this meeting? And are we videoing this meeting?
yes,
Our
we
MCA?
are videoing. I don't know where the agenda is. Oh, well,
our agenda that indicates what the agenda is and public comment and all those things, that we have to follow under the MCA guidance. And again, I apologize for interrupting the flow of the meeting here late like this, but I just wanted to make
Appreciate
sure.
you bringing this up.
And we have to keep the door open because
Yes.
it's a public meeting. And we'll need to take public comment to Champagne for our requirements. So did you say there's one posted somewhere, Nadine? Is it out here?
Yeah,
But we will look for that.
it's a big one. It'd be
Yeah,
huge.
I'm just trying to see if I can spot it as I,
If it's listed under vehicles, I would assume it's the same as law enforcement, to where the vehicle would be replaced at the cash value if none of that equipment was in there. And then whatever equipment is lost in that, then it would be replaced as replacement value.
got it right here, hold on a second here. So 24 Freightliner,
Yeah,
we have a 1,175,305.
Yeah.
The vehicle itself, you have it listed at 1,091,905, and the what they call like equipment would be another $83,400.
yeah, that sounds about right.
That's probably mounted equipment.
That was added.
Does that make
They
sense?
plug it in so it can be updated by just moving. Well,
So it wouldn't
Why,
be
thank
part
you,
of-
Raj.
Well, it just says, sorry, it doesn't show me the date. Well, actually, let me have the date out. Hold on a second here. I don't highlight random other things. Looks like we added it 6/4 of 2024.
Oh, so.
Actively, yeah, 6/4 of 2000, June 4th of last year.
Yeah,
That's about right.
Yeah, so would it have been added as part of our,
On the auto schedule.
okay. But I'm just wondering, as part of our increases from 24 to 25 on our coverages,
That would be a
I think that would be. an add.
substantial part of the difference in auto TIV from 8.9 million last year to 10.9 million this year.
That would make sense.
Yeah, that's gonna be that. A part of it.
Part of it.
Yeah, yeah, because that was a 1.97, about a $1.97 million increase.
Is there a practice that you're aware of that counties or cities are doing with these vehicles? Like, are they going out to KBB or
Mhm.
going and they just go, departments, they just take it out of the department's hands and say, we're gonna take the average on all of these and just call it good, you don't have to make a good decision.
A differential that MACo does versus like a standard insurance carrier. Is MACo looks at these ACVs on these vehicles, whereas, if you had a
ACDs.
actual cash
Actual
value.
cash
So they're just saying like, if you
I
have a,
really hate acronyms.
sorry about that,
Sorry.
yeah. If you have a 2017 vehicle, what's a 2017 same year make model worth today? So it does take that cost you out, but if you go to other carriers, Liberty Mutual or something like that, they only ask you what was the cost. They don't get into this like changing those values all the time. They have their own internal systems that kind of work through it, and they still just pay actual cash value, but they don't go by a shifting list price like the MACo program does, which is nothing wrong with it. It's just a matter of different techniques for different program carriers.
So Kelly Blue Books does have the option to do this. They have a subscription. They do have the free option, obviously, but the only difference there is it gives you that range. We do pay off of retail value. So we use Price Digest, but I think our subscription is a couple $1,000s because we do get really nitpicky on it. And then it's specific for Montana as well. Because obviously a retail vehicle here versus in California is going to be priced a little bit differently. But then I did find out last week that Kelly Blue Books does have a subscription for about $400, I think they said. And that one does anything that's considered under vehicles. So it can do vehicles as in cars, ATVs, snowmobiles, anything along those lines as well. It offers that to find the values there. So
Okay. So just trying to figure out,
Oh, you did say also a percentage, we do have some, so I have one county that's coming to mind in particular. Every 5 years, I believe they go through and with a fine tooth comb and do something like that to where they go onto Kelly Blue Books with each individual car. And then every other year they do a 5% decrease on total, because they have like a 200 to 300 vehicle fleet as well, so to do that annually is quite a feat. But so they'll do it every 5 years, I believe it is where they do fine tooth comb, but then every other year they will do a 5% decrease just to the total. Cause then even, if it's a significant jump and you're saving $30,000 on premium with it, and and this is speaking as a total loss, you don't have a ton of total losses every single year. So even if your vehicles were underinsured by $2,000 each, and you had 2 total losses for the year, so you are out $4,000, but you saved $30,000, you're, still up 26. So thinking about those as well is pretty easy. But yeah, that's a big cost savings there. And like I said, you don't think that it's that much, but it is death by 1,000 cuts. So I really like to stress that it's important that we look through those. And like I said, it's one thing for your agent to go through it, but your agent cannot change something that is not reported to them. So, and then one other thing, this isn't as big of an issue with some of these bigger counties. So you have some more rules and regulations with this, but for building and contents, speaking of, TIV is total insured value. So I'll refer to it as total insured value, but yeah, I hate them as well. So I'm with you on that. But one thing that gets a little bit squirrely is some of these shop buildings. So if you have any mechanics or anybody that uses their own tools and stores them in a county vehicle or in a county shop, if they are not providing an itemized list of everything that they have in that building or in that vehicle, and there's a total loss, they only get $5,000. And that to a mechanic is maybe a box and 2 wrenches. So that's not very, significant on the payout for that. So it's important that if you do have someone that's using their own tools and is a county employee, that they are providing an itemized list of everything that is personally owned by them and is being stored in a county building or county vehicle.
We did do that about a year, maybe 2 years ago.
Okay, great.
We had them itemize all their tools and then I sent off the list. I think.
Great. That one just scared me because I didn't know that until the renewal cycle, and I have 2 stepbrothers that are mechanics, and that would be life-changing if they lost their, cumulative of tools they've had over the years.
That should probably be updated as well,
Mhm.
because.
Is it likely that the individuals would have their tools covered under their own homeowners
Yes.
insurance policy, or
If they're smart.
if they're
Yes.
smart? Ah,
You
Yes.
can, here's a challenge on a homeowner's policy with this is typically when you schedule something on let's just say your contents of your homeowners. It's really contents at your home,
yeah.
inside that home, and there's a little jurisdiction around the outside, and I can't remember what it is on a personal insurance policy, but usually it's, on or within. Well, commercial policies oftentimes will get an extension to about 1,000 feet, but definitely from their home to a county shop building is more than 1,000 feet, right? So you get personal property coverage basically for your location. You don't get it necessarily just anywhere and everywhere. Does that make sense?
Yep. But they can have a separate
We
policy.
can do a floater.
Okay, there we
But
go.
they'd
I
have to
couldn't think of the
through
word
it.
anymore.
They'd have to think through this to do the floater.
Yes.
So it's just, your point is, a lot of times people aren't thinking through that aspect.
Yeah.
And they're saying, hey, I just was bringing this to work to be helpful at work, and I didn't think to call my personal insurance
Mhm.
and, make these alterations to the policy so I could take these things off site.
The only, like I said, if they're smart, because normally if you work as a mechanic, you have to have your own tools. They don't usually provide those. So if they're having to do that and have any experience working as a mechanic prior to coming to work for the county, then they should know that and they should be doing that. But then there's also people that are like, oh, what's the chance of a total loss at work,
What could possibly
etc.
go wrong?
Yeah, a whole building could burn down.
Oh, like, At a fairgrounds.
Yeah,
Yeah.
it could happen. Yep, it could happen.
I see.
That is why we have insurance,
That's
so. So yes, did we have any other questions on this part at all?
As a future follow-up on some of this type of stuff, so, the fairgrounds fire is an example, but talking through where we want to take risk and where you don't want to take risk, because we just talked about valuations on different things, and if you take your whole auto fleet and where they exist, and you look at what your auto losses have been from a comp and collision standpoint since 2018, hasn't been very significant overall. And so you think, what have we paid in premiums versus what have we had in physical damage losses? And these are some of the things I think are worth thinking through as we go about, because there is a cost to all this stuff from an insurance standpoint. And yes, it's great. It's great when you have coverage on certain things, but the other side is if you're choosing not to have coverage on things, you're not paying a premium on that either. So,
For example, in our fairgrounds case, it's my understanding we didn't have coverage on the building itself, but the building was 110 years old, and the structure's value was not that great. Stuff inside,
Correct.
but we had insurance on that. So
yeah, on some of the stuff inside we did. Yeah,
Okay.
There were some scheduled items that got picked up in that fire claim. So those are also discussions too, like where things are moving within the county and buildings and what's being stored where. But yeah, that getting back to the value of the building, that was a thought years ago of, hey, which ones are more critical for us to cover and which ones are not as critical. So
Do we have somewhere a list of facilities and whether or not we do have them?
Yep, we do. That's where this number is coming from. It's a list that MACo and we maintain together of all of our buildings and what is covered and what isn't. So usually it has the appraised value of the building, and then whether or not there's anything covered inside the building, so equipment inside it, and then that combines to the coverage. The building 2, which is Fairgrounds Fire Building 2, that old exhibit hall, it didn't have any of the stuff covered as part of the building, but there was trucks and other items that were inside the building that they had their own coverage as part of the other list. So we did have some coverage there with some of the stuff that caught on fire.
And with that, so normally that list is referred to as a schedule. So if you hear us talking about a schedule, that's what we're talking about, is that list of items that we have there. Translation.
thank you.
Like, I don't even know what it is half the time. I just nod and smile. Okay.
But all good questions and just like I said, I didn't mean to interrupt your.
No, please.
Just food for thought on those items.
Yeah, that's great. So then if we switch to the next page, this one is pretty self-explanatory. These are just the deductibles for each individual category that we offer. I normally go through and just make sure that nothing looks squirrely here. If it's too low, too high, you guys have the $10,000 across the board on this, which makes it relatively easy and is pretty standard for a county of this size.
What does on the zoning and ethics and the floodplain and number 1, number 2, number 3, what does that indicate?
So those are 3 other endorsements that we have. However, I have not had to work with them very closely. So I have an email write-up of this because I was not confident in my ability to explain this off the cuff, which I'd be happy to grab my phone and look for you if you wanted a definition of it. But I didn't want to flub this in case anybody asked. And I haven't had anybody ask until you. Go figure.
Who makes that? Okay, let's just move on. That's,
Okay, I can email you though, so you have
Yeah, that'd be
so you have
interesting.
that.
Thank you.
So like I said, we don't have a ton of claims in on that end, so I've not had to work with them very closely to be able to give you a definition of what each individual covers.
Okay.
Can you tell me how long we've had a $10,000 deductible on this?
Not off the top of my head, I don't know.
I don't remember either, but it's been a while.
I can find out.
And then when are
Number of
the
years.
time to be considering raising that deductible just because of it might
We
be
looked
saving
at
us
that
a
one
lot.
time. Would have been actually
did as well,
quite a
and
few years ago, but I didn't think there was much break at that time.
Well, and
But
I'm
it'd be
pretty
worth looking at it.
I'm actually pretty sure for these three specific, the zoning, ethics, and flood, that the only deductible for that one is $10,000. So the other ones can be adjusted between 500 to 25,000 on average, is what they fluctuate between. But I'm 90% sure these last three, that the deductible across the board for every county is just set at $10,000, which I can confirm for you though.
But I think Tom brings up a good point. The other 10,
Mhm.
if by raising the deductible, that could change some of the cost of our insurance. It might be information that would be helpful to us in,
You might look at a $15,000 or a $20,000 deductible.
We could, the only unfortunate that we could absolutely do that. So there's my answer
or
to start
just give
that.
us a list of it so we can see.
Yep. The only thing is unfortunately, with deductibles in a pool, changing the deductibles doesn't adjust the premium as significantly as it does if it was your vehicles or homeowners policy. So we did have one that went to the cap, and they only had, which they did have a $14 million increase to their property value. But they only had, I think it was a $26,000 decrease in premium on adjusting that. So I mean, $26,000 is still $26,000. But yeah, it doesn't make as big of a difference, unfortunately, as it does for personal lines. But I could absolutely look into it for you.
If you
That,
could,
yeah, I'm sorry to
yeah,
interrupt you. there.
but provide us with a table so we can look at it
Mhm.
and say,
Absolutely.
Frank, what does this mean?
Yeah.
Yeah.
I would hope that though
Fair
kind of mirrors my memory of our conversation on this. This goes back probably
I was.
5-6 years ago or something. I think it's that long. maybe.
I don't think it's that long, because Colleen, they're gone.
Oh, yeah. Anyway,
I thought we actually looked at it once as well, and again, the savings was just
wasn't
not
huge
that
for the.
huge, but
Yeah,
the
so it's
changes.
like,
But
it's
it
all-
is taxpayers' money that we're talking
Oh,
about
yeah.
here,
Yeah.
so
Nothing wrong with looking at it.
we have to,
yeah, and that's where you have to look at the differences in claims. So, okay, we could go through your, which is up next, basically. If you were to go through all of the claims that you paid, let's review that and look at, okay, if you would have paid 25,000 or had your deductible set at $25,000, would you have paid out more money on that self-insurance under the deductible portion, or did it end up saving you money in premium? Because you might have had $100,000 worth of claims and you only saved $20,000 worth of premium, to where if you would have kept those deductibles lower, then you wouldn't have had to, you would have only paid $20,000 instead of $100,000. So it's not just looking at the deductibles, but looking at your claims as well to make sure that we are saving taxpayer dollars overall throughout the year and not just upfront on the premium.
okay,
Does that make sense?
Yep.
Okay,
absolutely.
sorry. Like sometimes I start to ramble and then I'm like, am I making sense here? I
Well-
might be just rambling at this point.
But my questions kind of run that way too. so
Okay, great.
You're doing fine.
We're on the same language here.
It's frightening, isn't it?
Yeah. All right, next page. This is basically the breakdown that I had said earlier with the 2% increase for inflation, liability, 5% increase to pool base rate, boiler and machinery and equipment breakdown. There was no change there. There was a slight change in fidelity and crime. So we're now sitting at $18.93 per employee, where prior we were $18.03. So we had a 90-cent increase per employee there. And then terrorism, there was no change. But this is kind of the gold over here under the property side. So overall 4% base increase to the pool base rate, sorry. And then the breakdown as to how we calculate everything. So we had someone call and they had a small shack that they wanted to add to their schedule, and it was just over $4,000. So I took our 25-26 contributions, or not contributions, calculations for building and contents, and it ended up being $12 annually to add that to the schedule. for what they would pay in premium. If that would have been my homeowner's policy, it probably would have been closer to $120 per month to add that on there. So that really kind of put in perspective where our rates are versus in personal lines. Commercial is a little bit different. And then I was able to find out, I believe this competitor, this was their 24-25 rate, but even after our increase this year, we're just over a quarter, and I was told that they were at 30 cents per $100. So we're still under by about 3 cents, 2 and some change cents there, which I was happy to hear. And then even for equipment, I had a meeting this morning, and the agent that I was working with there, he was trying to negotiate coming down on equipment for how much they were charging there. And his negotiations, he was having a hard time getting them to 50 cents. So that was a fight to get them to 50 cents per $100 on equipment. And we're sticking to the 44 cents per $100. So once again, we're still under the open market rate. Any questions on this one? Okay, and then next up, this is the property and casualty loss ratio. So how we calculate this is basically how much you've paid out in premium based versus how much we've paid out on those claims. So thankfully, we only run a 3-year loss ratio. So 21-22.
No, wait, why thankfully?
Because in the open market, a lot of times though, depending on who you're quoting with, it could be anywhere from 5 to 10 years they'll request.
Oh.
So it sticks with you a little bit longer than we like for it to.
Okay.
And there are some also that run 3 as well there, but the ones that we're competitive against are usually a 5 to 10 year ratio from what I understand. So then 21-22, you were at a 42% for liability loss ratio and 0% for property, which is fantastic. And then 22-23, 54 for liability, 5% for property, fantastic. And then 23-24, 26% liability and 0 for property. So totaling 40% for liability and 1% for property. That property loss ratio is great. The liability could use a little bit of work, and that's where we jump into that on the next page. And this next page gives you a little bit more visual. So if you have any questions, you can still ask those here, but I like to jump into this visual first. But 85% of that is your detention claim. So that's detention and sheriff across the board, though, is our highest liability, not just for this county, for everybody. But here it is significantly higher, as you can see. Clerk and recorder 0%, technical services 1, sheriff 1, road and surveyor, that's pretty standard at 10%, or that they'd be the second highest, and everyone else is 1% or lower. And then the one thing I did want to point out is overall for liability, if you go down into the list, this Excel sheet that we had, the law enforcement liability, there are 24 claims there out of all of them, which is relatively high. For property, you're going to have, I mean, they're on the road quite a bit. So you're going to have your claims there with hitting deer or hitting pheasants or, whatever rodent decides to come out and jump in the way. But that is what is hitting you the hardest right now when we're using these for the modification factor is the law enforcement, I would say. And then the only ones that are still open are the class action lawsuits. Or lawsuit, I would say. One per se plaintiff alleges he was wrongfully incarcerated for 8 months on a Colorado warrant in 2022. There's a few of those on there as well. But these were run a few months ago, so if there has been any development in them, some of them could have closed by now, and I can get an updated one for you if you're interested in that. And then one thing I like to point out, the total paid versus the total incurred. So if some of these claims are open, you'll notice that total incurred is significantly higher. But the point of that is they set those aside for reserves. So I'm sure you understand, our claims teams looks at a situation that's presented to them or a claim that's presented to them and thinks, okay, normally when we have this type of claim, this is how much it costs So they set aside that amount in their reserves. So they are budgeting for that properly. That doesn't mean that that is what they will end up paying out on it. Fingers crossed, normally it's less. So you can even see, I mean, so the first one right off the bat on liability from 7/1/21, total incurred is $37 or excuse me, $37,000. Total paid out on is 0. So I mean, that could potentially close out at 0. But that's what they have set aside for it for the total incurred.
Does that make sense? So what they're showing is what they've actually paid. The far right is what they think they're gonna pay additionally. And the middle column is what they think the total cost is gonna be with the paid and possible additional. So the middle column just says, this is what we think this total claim is gonna be.
Yes.
Okay, all right,
That makes sense?
yeah, that does make sense.
So when they close, as you can see, the closed amount, or for the closed rows, those two columns are the same for everything that is closed, for the total incurred versus total paid. So once the claim closed, it will match the paid out versus having that set aside for the total incurred.
On October 3rd, 2021, closed expense sharing with General Star. Who is General Star? I assume it's an insurer.
That's another insurance. Oh, yeah.
Third party.
That'd be so you probably had some ability to subrogate or an ability of another carrier that came in and participated on the claim with you. It was a
Maybe medical.
outside claim party, so they took part of the claim. Or at least part of the defense expense that took place in the claim, so it reduced your cost outlay on it.
And then your property is pretty low there. See, at the very end, Debbie struck elk with, which I've had a ton of elk today, and for whatever reason in my presentations. Any other questions on those claims at all?
Looking at February 20th, 2023, plow was grading when it hit a rock, causing damage to blade. And it was almost $12,000.
Yeah, those ones can be. Those ones can be significant.
So Chair Payne, I'll just state the obvious, and I'm sorry, everyone, I'm Roger Baltz, if you don't know, I'm the CAO.
And he's the one who knows what's going on.
Yeah.
I know we talk about this many times, commissioners. This just reflects how crucial training is, how crucial our safety programs are, and how dominant, how issues of expense and liability can be dominated by law enforcement and the detention center operations that we have. If you look at the open cases on the list there, I know that's stating the obvious. The other thing that I just wanted to mention in your packet is if you look on the next to the last page, there's a picture of Nancy Everson, and she looks extremely happy in the sunshine. You all know that Nancy worked for us for 20
Yes. Yeah.
I hope you'll pass along to Nancy. We miss her.
Yes.
I hope she's doing well. But she looks awfully happy. I just digress. If I could circle back though, when you talk about the increase to the base rates, did the PCT trustees approve those rates of the 5% that you mentioned for liability?
It was their decision. So
It was their decision.
what happens is our actuary comes in and gives us anywhere from 1 to 5 options as to what the minimum amount that we would need based off of the claims, the incurred but not reported, our reserves set aside, etc., on what keeps the health of the trust in a safe spot to where we won't go backwards with spending money on claims, etc. So they present those to the board, and then the board votes on the options that are presented to them. They've never gone to the highest, but they've also never chose the lowest either. They usually go middle of the road with that.
Thank you for that. What I'm recalling is that last year when we had this meeting, that you all had expressed a couple of things. I hope I remember correctly. One of them was that the fund, if that's the correct thing to call it, seemed to be in pretty good shape, that you had about $5 million to work with at that time. Is the fund still in good shape for the trust?
So the overall, like the pool fund,
Yes, the pool.
yes. So they have it ranked in red, yellow, green zone, and we are inching our way up to the green zone. However, we are still in the yellow currently, but that's why they come in with the options that they do, to make sure that even if we choose the lowest option, that it still keeps the trust progressing forward and not backtracking into negative numbers, or negative health of the trust, I should say, not necessarily negative numbers.
Okay, thanks again.
Yeah,
And
of course.
and the renewal comparison that you've already gone through with us, so we're looking at this year for budgeting for next fiscal year, a need to increase our property and casualty contribution by $229,596. So it's a little over a 16% increase. It's 16.47% increase that our good partners at MACo are looking for from us. We've been with them for many, many years, commissioners. So I just wanted to kind of just call out the big picture of what we're talking about today, and that's an increase of just over 16%, or 229,596. Again, if I did my math correctly. Frank, please correct me if I'm wrong down there, if I'm missing something. And I also just wanted to let you all know that we appreciate the partnership and the service that you provide.
Thank
The legal defense services stands out to me over the past year. Some really excellent work has been done for our county, and I hope you'll pass that along to whoever
Absolutely,
you
I
all
would
work
love to
with,
do that.
that we certainly appreciate all that. But we've seen a trend for many years now of double-digit increases associated for the reasons that have been expressed, Commissioner. So just some things, just big picture, high-level things of what we're looking at today and you're being presented with. The claims experience is excellent to look at. And boy, don't we love seeing that category say closed, on the far left, for as many of them as we can see. But there's still some very substantial ones that are open. So, Frank, I know you and I talked about our budget for this year. In addition to this, commissioners, I hope I'm right, guys. Please correct me if I'm wrong. But some time ago, you all stopped offering cybersecurity coverage. And so we need to go, I think 3 years now, we've been going out, or maybe 4.
We use it different.
That we go out for cybersecurity related coverage, commissioners, just as a reminder. So just a few miscellaneous things talking about insurance today.
So one thing with cyber, one of the reasons that we did drop cyber is because we did not have the manpower or the knowledge to be able to support what was going on there, and the multi-factor authentications, et cetera, all of basically anything that was needed to support a cyber insurance policy. However, on our very last page, that was one of the last things that I was going to address. Carly King has started, she's our IT manager, and she started the member cybersecurity and technology program. So we have been, Carly, myself, and our broker have been in discussion about bringing cybersecurity back into the trust, because now we do have the knowledge and the manpower to be able to support that. So you wouldn't have to go out for a separate policy there for cybersecurity.
Thank you for doing that.
Yeah.
So, just so I understand probably what everybody else does. Our MACo insurance covers 90% of our insurance costs, and then we still have to go out and get insurance for cybersecurity. Is there anything else we're not?
Workers' compensation is kind of done through MACo as well. It's a separate program, but it's Montana State Fund does the workers' compensation insurance.
Yes, they do.
So it's part of the, let's say, the MACo program per se.
Mhm.
It's just done differently. It's not part of the trust.
Correct. Okay.
It's actually
There used to be a trust.
Yeah, there used to be a trust for it,
Now
but so what's happened now is the risk of the workers' compensation is actually offloaded to the work comp carrier. It's not a pool mechanism at all, like the
Okay.
property and liability coverages are.
So do they have that individually through you, or do you know if they're doing the blue and gold with sites insurance?
So, yeah, we handle the workers' compensation
Okay.
insurance, but they are part of the blue, I can't remember if they're part of the blue or the gold right now.
Okay,
But
okay.
yeah, they're tied in with that program. The blue and the gold is just a,
I hope this doesn't have anything to do with bobcats.
It does not.
I guess MACo's covered.
Yeah, that too. And Montana State Fund, actually.
but anyway, yeah, I've always wondered that same question.
Yeah.
Anyway, so that there is a tie-in with MACo though on the work comp program with the Montana State Fund.
Okay.
Chair Payne, if I could, just a couple more quick things. I'm just curious, is reinsurance a concern or a challenge for you all?
So that we actually discussed that in the beginning. Yes, it
Oh,
is.
sorry.
No, it's
Please don't repeat. it.
no. Well, I can sum it up very quickly. So basically, we were at potential for being dropped because of a large claim that there has been determined that there's no coverage for with one of the special districts. They misunderstood what was going on with the claim, threatened to potentially drop us. Our reinsurance there is just under $1 million. Well, with the potential for being dropped, we had to go out and look for the second best option. Second best option was $4.2 million. So that's one of the main reasons we have to make sure that the trust is in a healthy spot. So that way, if there ever is that reckoning to where either our insurance carrier jumps up to market rate, or we end up having to go with a second option, that's not going to hit the county members there.
Thank you. Appreciate you repeating it for me.
Of course.
Did you all talk about special districts? Are you still not insuring special districts?
We are not doing special districts. Yeah.
Just, Frank, what do we pay for our cyber insurance?
I believe it's in the $25,000 range a year annually.
Oh, okay. Anything under $1 million.
Yeah, I think it's
It's not
actually,
close to that.
Yeah.
hopefully we don't have to use it, but.
And
that's a
then-
whole different game.
Yeah.
Because you can avoid your insurance really easy with cyber insurance if you can't negotiate certain instantly if St. James was gonna negotiate right away just to try to mitigate something, or you saw an opportunity, you would immediately like mitigate the security insurance. There's certain things that come along with it, so we've been trained on it and talked about it, but as soon as that happens, you gotta go into a protocol and allow them to take over essentially the insurance company because they want to be in control. But that's why you guys don't cover it, because I think there's a lot of nuance to cybersecurity.
Yep.
These things happen, I mean, just history here, but market got tight in that space. Multi-factor authentication became a key priority, I think, for the carrier that MACo was using on the reinsurance side of that at the time. But multi-factor authentication became a #1 priority for almost every cyber insurance company out there. And if you looked throughout the counties in the state, some had it, some didn't. Some had an IT team that could help, get all that stuff up and running. Others really didn't have an IT team, and so you had this major variance of what resources each county had from one to the next, and so it became very hard to have a pooled program with resources doing this.
Yeah. And on top of that, a lot of counties were not honest about having multi-factor authentication. They would say that they did, and then either would not allow it to be double checked that it was adequate, or would just blatantly lie about it. So there's that as well. But now we have the team that has the resources and the knowledge as well, to handle all of that, which will be really nice. So fingers crossed. I don't have a ton of details on it yet, but we are working with our broker on it, on finding that to include it in our policy. If we did, fingers crossed, the game plan right now is to announce in September at our annual conference, and then hopefully have a policy ready to go by December. And we would either do a 6-month policy or an 18-month policy to where it would be on the same renewal schedule as the property casualty. So that would all align there. There's just a lot of details and it's very meticulous to get that up and running. So that's kind of what we're working through now with cybersecurity.
How many members do we have in the pool now?
We have 49 of the 56 counties.
49 counties?
Correct. Yes, sir. Yes, we do have a few that have voiced interest in coming on, which we are discussing. But as of right now, 49. So hopefully a few more soon. One of the other things I like to point out is, as you said, we do have our county litigation group, which is what we're moving into next right here. So I guess I'll just jump into this first, but these last 2 pages that I have, they kind of go hand in hand together. But a lot of times people look at them and say, oh, you just settle claims to make people go away. And that is not the case. I had one commissioner that was very upset with Mr. Payne that he settled a wrongful termination case. However, it was for $15,000 to the plaintiff. But if you looked at the total incurred cost on their sheet that I provided for them for the claims, the cost of it was $85,000. So they settled. And even with settling, 15 of which went to the plaintiff, it was $70,000 just to settle with attorney fees and whatnot. So if that would have gone to trial, it could have been well into the 6 figures easily. And thankfully, our attorneys are not afraid by any means to go forward with trial or however they need to assess and handle it and whatnot. But we've even hired outside counsel to make sure that we're not overloading our CLG county litigation group or anything along those lines. But with that being said, this little pie chart that we have here, and I will preface, this is the entire pool, not just York County. I have scared a few commissioners by not prefacing that. But over the last 10 years, the total liability claims. So 50% of them were resolved without indemnity. Indemnity means to make whole. So basically it was denied or there was nothing paid out on the claim for whatever reason maybe, but that's 50% of our claims over the last 10 years. So that proves that that is not the case that we just settled to make people go away. 34% settled indemnity, which would be anything from mediation to trial, what we paid out with those. And then 16% settled medical or bodily injury. So anybody that's been injured in a claim, what we've paid out there. And then next page is basically the same thing there, settled indemnity or bodily injury at 33%, and then a total combination of the resolved without indemnity of 67% over the last 10 years. Did we have any questions on that one there? All right, and then our last page is our risk management services. Over on the left, we have Dan O'Malley and Brandon Harris. So Dan O'Malley is our public safety risk manager. He has been a great resource for some of these counties to get things such as body scanners in there or just provide different resources there. And then Brandon Harris is our peer review coordinator. He is just now starting to get out on the road and put that group together for peer reviewers. And I was informed that we were referred to as the Montana Association of County Commissioners and not the Montana Association of Counties. And there is a large gap between MACo and the MSPOA, not specifically the group Montana Sheriff and Peace Officer Association. So not specifically with that association, but just with law enforcement in general. Not a fan of MACo. And I am very, very proud of Dan and Brandon because it is palpable, the tension lessening. Sheriffs, I'll give this example. So I am going home for a funeral this week and I've never seen the detention facility in Richland County. Last time they were there, he said, well, maybe next time you're in town, give me a call and I'll decide if I want to let you tour our facility, basically. And I don't know what kind of work they've been doing, but I thought, I've never seen it. I'd like to see it. we insure it. I need to know what's going on there. And Brandon reached out to the sheriff of Richland County. He said, have her call me and I'll do a tour. I'll get a tour scheduled for her. I mean, no hesitation whatsoever. So it is a significant difference there that we want the sheriffs and law enforcement to know that we are on their side and that they are heard, etc. So very proud of them. They are also doing some work with getting grants for law enforcement or jail commanders to send them off to do different trainings, because as we saw, that's our biggest liability is law enforcement. So if we can send them off, get training that's going to help assist in that, that's fantastic. I apologize, I can't remember what county it was, but they did send some off for a jail commanders training, and they reported back that it was fantastic. And the only cost to the county for them was travel expenses, but the cost of the training was covered by that grant. And then next up, we have Mackenzie McCarthy, who is our general counsel, and she is who, she's our HR as well. So if you have anybody that you're looking at potentially terminating, she is a great resource for that, to make sure that we are following the proper protocols and that you have the right situation to let them go. There have been counties that have been upset that they did, because with that, if you follow the proper protocols that she recommends, we give back the deductible if it ends up that they file a case and we have to have our county litigation group jump in. So if it shows that the proper protocol was followed, we waive that deductible. However, I had some counties saying, oh, well, we didn't get it back. Well, just emailing her and saying, we're going to fire this person is not adequate, because that person should, a conflict of personalities is not a reason to fire somebody. And so keep that in mind, but a great resource there. And then Karen Alley can assist on that as well. She's our associate general counsel, but her main focus is zoning and land use. So she's a great resource there. And then, as you know, Nancy Everson, our governmental finance director, she's currently doing something called Money Mondays. And I've had a few commissioners report back that it's fantastic. I think it's, I haven't had time to watch one or partake in one recently, but the reports have been great. Obviously, balancing the pocketbook here is a little bit different than our personal pocketbooks. So, and then last but not least, Miss Carly King, our IT manager. And as I said, she is the one that is working at getting that cybersecurity up and running and anything IT related. She is a fantastic resource, as well as cameras. So cameras for courthouses, cameras for detention facilities, any county-owned buildings. We had one where they had originally been quoted $44,000 for cameras for their detention facilities. They have quite a few blind spots in there, but that was just completely out of their budget. And she was able to get them quoted for $15,000. And we have one pilot program going right now, and they are ranting and raving about how much they love these cameras. So it is not just a cheaper option, it is a quality option, which is great.
Can you say Carly the one helping on cybersecurity?
Yes. Yep. Yes, she is. And that is all. The last page is basically everything that I just said.
I like this one with the picture of Dan O'Malley behind bars.
You know, that seems to be a fan favorite. I've referred to them now as Team Chaos in the best way. And I mean that as a term of endearment, but they are a good time. And of course, as retired detention officers, or not detention officers, but sheriff deputies, they thought it was funny being behind bars. And Brandon Sweetie said, you should send this to my wife. I was like, oh, okay, I'll send it to Claire. So, but they're a good time. One thing I do like to point out, just some of the other benefits of the pool. One thing that we do have is a $5 million builder's risk policy that is included. So if you are doing any sort of renovations and are looking for a builder's risk quote, we already have that included in it, $5 million. I did have one that he actually scared me, and I think this is relatively high, but it might be, I don't know what the situation was, but he started talking about going out and quoting for builder's risk, and the bill was about $70,000. And I thought he was referring to the county, and I about melted into the table because I was like, oh my God, please don't tell me that you quoted this for the county, because we have it. So he went out to market for a $5 million builder's risk policy, and he said that he couldn't find it. The only ones he could find were about $70,000 for that. we have that included in our policy. So that's at no cost to you. On top of that, as you're adding different vehicles, buildings, equipment throughout the year, we do not charge you premium until the next year. So it will hit you at the next renewal cycle, but if you add something on there on July 2, July 3, then we're not going to charge it until the next policy year, which in the open market, you're going to be charged for that right away as well. So just some more flexibility that I think is extremely beneficial with being in the pool. That's all I got for you. Did you have anything else to add in there?
No, that's, those are two, pretty unique perks, actually.
Yes.
The builder just built into the program. And usually very few carriers have that out there, so that is a unique thing. And then the midterm, no charge for an addition. Nobody else does that either, that I'm aware of. I mean,
Like it's non-existent from what I understand. So major benefit there, but
Chair Payne,
Roger.
would you have any recommendations for Lewis and Clark County regarding any strategies that we might employ to stop these rate increases from occurring? Just a big picture question.
Oh, safety training. I mean, the biggest factor here is going to be your loss ratios. So just significant losses. Your property is doing great. So that's obviously not an issue there, but liability wise, one of the meetings I had this morning, and this was from a work comp perspective, but they started doing trainings and following their safety coordinator with work comp. But that in turn, you know, kind of works hand in hand with liability and property as well. Because if you're increasing in claims come from both sides, basically. So that's where you're going to see, I'd say the biggest decreases is with just limiting claims. That's where you guys are getting hit the hardest, is with those liability claims. And so if you have another year where you have low liability claims and these two drop off, then you would see a significant decrease in what your premium increases are going to be.
Thank you. Would increasing deductibles have any impact?
Slightly. That was another thing that we discussed with deductibles. Unfortunately, changing the deductibles does not have as significant of a difference in this as it does on your vehicle or homeowner's policy. And then we also discussed looking if you're saving money up front with your like decreasing premium because you've increased your deductibles, we still want to make sure that we're going back and looking at your claims. So if you've I'll use $100,000 just to really prove the point. If you set your deductible at $100,000, so everything under $100,000, you guys are paying out of pocket, but then going through and say that only saved you $30,000, $40,000, but you paid out $200,000 worth of claims that year, you saved that $30,000 up front, but you ended up coming out of pocket $70,000 or, you know, whatever I said for how much you paid out in claims for more there. But I mean, this is really a long game strategy here, because what's hitting you the hardest is those liability claims. So if we can get the liability claims down through trainings with law enforcement or safety coordinators, etc., then that's where we're going to see more of the decreases in premium there.
Thank you. Commissioners, you understand the question I'm trying to get at. What can we do to limit our cost year in and year out with our budget? Thank you very much.
You're welcome. And one other thing I do want to point out, because obviously these rates can be frustrating when they're double digits. But we had an airport authority that had, I don't even think it was a total loss, but it was a major loss on a fire in one of the counties. And just based off of that fire alone, they had a 35% increase to their premium. So yes, 16% is not minimal by any means, but if you're having these continued claims out in the open market as well, you are going to see significantly higher rate increases, and they are not going to have as much forgiveness as the pool does, unfortunately. So Insurance is just hardball in general.
So it appears that we're getting a 16% increase.
Correct.
And can some of that be attributed to the inflation we've been suffering? I mean, haven't we had?
Yeah, so that's
So
where,
that would cut back on what the actual amount of the increase is. I mean, it's something we live with.
so it would be a 2%. So that's what the board voted on, was a 2% increase for inflation this year. So if you took the I don't know if that is my math, here's my algebra here. But take 2% off of that $1,623,603. 600, I said that wrong. I'm getting jumbled now, I apologize. But if you were to take 2% off of that, then yes, that would be a 2% decrease there for inflation alone.
Can I ask you a quick question? At the beginning of the meeting, you said 2%, 4%, 5%. What was the 2% I thought was the property inflation factor? Was it overall program inflation factor?
So that 11%, the 245
Yeah.
is for the pool base rate. So across the board, the pool's base rate was an 11% increase in total, broken down by that 2% for inflation, 4% for property, 5% for liability.
I wrote it down wrong earlier. Thank you.
Yes.
I had property on the 2%. So thank you.
But even on top of that though, you know, that $3.84 million increase in total insured value, you had just under 4 million. I'm so sorry, I'm getting number dyslexia as I'm speaking. But just under $4 million increase in the amount of property that we are insuring. So that's just over a 3% increase. So if you had stayed where you were last year and had 106 for buildings and contents, 9 million for vehicles and 6.4 million for equipment, that would be 3% less than that 16.47 as well. So then if you took off the inflation, or well, I guess that would decrease the pool base rate as well, but you know, took off that 3%, then you're looking at 13% increase, which is just 2% above that pool base rate that the board had voted on.
From a broader perspective on just different ways to control costs, some of it, you know, like I said, we talked earlier about taking some risk, you know, so maybe if you got a deductible on some, well, you got a $10,000 deductible on auto, as an example. If we have any vehicle that's close to that $10,000, we could look and see what the cost would be if we were just removed the comp and collision, just kept liability only.
It's not a bad idea either.
So as we look through that list, even on the equipment side of the list, sometimes I noticed in here we had a couple items that were scheduled that were under $10,000, and this is, you know, if it's all one loss, so like one fire loss, you could have something that's under $10,000 that gets picked up as part of that one claim because there's a bunch of things happening in the one event. But on a one-off basis, that thing wouldn't get covered at all because it would be under your deductible. So if somebody, just say it's a generator or something that somebody comes in and steals, it's under $10,000, you're gonna take that loss anyway. So scheduling it, you paid some premium on it, even though the claim happened on that individual piece, it didn't help you. So if that makes sense, smaller pieces, we have to have a loss that has more calamity to it than that one item to actually have it reimburse you. So there are some things we can look at from that perspective that might help curb it a little bit.
Is that kind of like the building that burned down out there, that out of the fairgrounds? The value, it was a very old building, and the actual value of the building, is that the sort of thing you're talking about?
I think going back a number of years, the county looked at some of these buildings throughout the county and said, hey, these aren't our, you know, buildings that we are, you know, that we would need going forward. So they, you know, you talk about like the main fairground building. It's a building you'd want to cover. If we lost that, it would be a big problem. I think they looked at it that way and said, where can we save some premium dollars on some some buildings that, you know, we could essentially do without. Obviously, you'd like it not to happen, but so I think that was sort of the thought process along that front. So that's why part of some of the items in the building got picked up in the coverage, some of the different equipment items, that is, but the buildings themselves on those were not. But they're older buildings. There's challenges on repairing or replacing them to some degree as well. So you did take some premium savings over a time with that front.
2 questions. Do you lease any equipment at all?
Not that I don't
Okay.
remember.
The only reason I ask is because a lot of times those are seasonal, so the premium is for the whole year, but if, yeah, so, well, so the premium is going to stay for the whole year, because like I said, when we're adding things on, we don't charge for that, etc. Same thing, taking it off. But if you're taking it off and you want to make sure, if you do have seasonal equipment, that you are not forgetting to take it off, because then if you get a new piece of equipment next year for that season and you didn't remove it at the end of the first season, then now you're insuring 2 pieces of equipment when you only have 1. And I've seen that, I don't know how many times. And then were you here when we were talking about actual cash value versus replacement on vehicles?
I was not, but I'm familiar with the topic.
Okay, so that just for, that is one of the biggest places that I see a cost savings, and it is death by 1,000 cuts. So we discussed, he was able to find, I think, 1 or 2 vehicles that were potentially a little overinsured that could make a significant difference there, that we discussed. But I like to drive that home, because I did have one county that ended up making over 115 changes to that, and they ended up having a 10% decrease from what they were going to pay on their premium. So I mean, it can make a massive difference on that. So it sounds like, which fortunately and unfortunately, he's been up to date on them. So he's been updating them. But if you had a 10% decrease, then you'd only be paying 6.47%, which would be fantastic.
And
So
thank you for bringing that up.
Mhm.
And if I could, so commissioners, actually Frank and I were talking about this just the other day, right? About what buildings do we have that if something were to happen, we want them to be replaced to their historical condition, right? Well, obviously this building, but it's covered under the city's insurance because we're joint owners. We thought of the Myrna Loy, and we thought of our courthouse, of course. But the Murray building and many of our other buildings, they're more modern. They don't have the historical components. So that's where our list took us, right, Frank? We didn't think of any others.
Those are the only 2, and I believe that Marty let Bonnie know that those 2 we're asking for an appraisal to be done at the
historic value.
Yeah, at that cost. And then I would imagine you guys would respond as to what the increase or what the coverage change between the 2.
Yeah, yes,
If
we
we
will once we have it.
So we'll bring it to you and you guys can make a decision as to, we'll have a recommendation as to what to.
So this is off topic just a little bit, but Commissioner Payne, remember our building advisory board a few weeks ago?
Yes.
Do you remember the city was talking about this building?
Yes, they were.
If this building was wiped out and we wanted to rebuild it with the same type of historical components, didn't they say that their estimate was $63 million
It was.
to reproduce this building? I'm not sure if that's what the number was or not, just as an aside.
But they also said that this building stood the 1937 earthquake.
Yeah, sorry,
Took the whole
just over here.
Are you hurting our equipment?
Well, my belly's getting big, so I try not to get too close to it, and then I end up hitting it with my knees and breaking things. So I'm like, okay, just sit there. That's fine. But one thing I will say, I didn't mean to interrupt with my chaos over here, is Kalispell, they have a historic building, but they just gutted and remodeled their courthouse and the one, I don't know what it is, but whatever is right next to them. And they did it as replacement. and which was significantly less versus historical cost. But they just chose options that looked historical. So the only difference was the staircases are not marble, but they look like marble. So it's still, I had no idea that it was not historically remade. So that is something to keep in mind, is you have the option to choose wood, carpeting, all the things that just look more historic versus doing the hand carved staircases and marble flooring. So that could save a significant amount of money there as well. So I've been pointing that out, that you have the option to just make it look historic versus to actually make it historic.
We're starting to see some insurance companies as a whole come out with that same platform to say, hey, we're not gonna hire an Italian mason to come out and do this
Yeah.
by hand.
Well, the
We're gonna-
sandstone that we
yeah.
have building,
Yeah.
this building is, and it's quarried.
Yeah.
Not too far from here, who even knows where those quarries are at?
Yeah.
What it looks like. And
So some carriers are already are thinking about that same topic. It's very hard to replace things, like this building's a great example. It'd be very hard to replace it with the same materials and all that type of stuff that you had.
But to your point with the $63 million replacement of this building, that was one of the lessons that we learned. We had a county that did decide to restore the building to historical value, and it was $10 to $12 million more than what it would have been at just replacement. So that's why we're giving the option to have it appraised at historical value now. So, but like I said, Flathead is a beautiful building and it looks very historic, and apparently it's not officially historic. So something to keep in mind there if you're interested or teetering on that.
Are any of those, I mean, some of them might be on the historic registry, so you may not have the choice, actually.
I've had some counties run into that as well.
Yeah, which is I think that's probably a good thought to have them appraised on that front.
Hey, could I just jump in very quickly here and just kind of state the obvious? So commissioners, what we've been presented with today is a little over $1.6 million, right, to for our property and casualty insurance through MACo. And at the end of this month, we're going to be having all of our budget presentations. And Commissioner Rolfe, I remember just the other day, he said, hey, Roger, what kind of increased cost are we looking at in the coming fiscal year? Well, our costs for property, we refer to these kind of costs as fixed cost in our budget. And so this particular fixed cost, we have many of them, but this one will be up by a little over $220,000 in our budget to go along with the COLA, for instance, that we've talked about trying to give our workforce of 2.13%. We may or may not see the sheriff come in and want to take over courthouse security. We've talked about that increase in cost to do that. So we're compiling that list, an answer to that question of what are the increases we might see for next fiscal year. But this would be one of them, what we've been talking about today. So, but the total's little over $1.6 million. And it's up from $1.4 million, which was the cost this year.
I've got a question if I that and maybe I missed it and we talked about it, but do we have a earthquake rider on any of the properties here?
I don't know if earthquake is included in our coverage, but I will find out for you.
Homeowners, I have to pay that extra.
Yeah, usually we don't. This is an expired term, but usually it's referred to as like blanket coverage. But we don't have blanket coverage, but we combine policies into one. So that way you're not having to add in DNO, add in errors and omissions, all these different policies to make sure you'd be covered as you would in an open market. But earthquake, I am not sure. That one I would have to ask on. So I will find out about that one for you.
check the earthquake.
Well, I don't believe it's part of this program.
Fire
Okay.
is included, so it's excluded from our reinsurance, but we do include fire. for wildfire as well as building fire. And we don't score on it as well, which is a huge issue in the open market. And it is, well, we'll insure this piece of property right here because that's scored on this level, but this one right here, we're not going to insure. So, and I mean, it is properties that are directly next to each other that it's causing huge issues. So in more of those mountainous regions, but you don't have to worry about that with us. We just cover it across the board.
Can you tell the 245 again? The 2 was that
Inflation,
was inflation. 4
property
and then the 5 again.
for liability. So that's on the
That's
1,
just the
2, 3,
base.
4, 5, 6, 7. Page 8, that's on. I apologize, in the property, I didn't put the percentage for 4% for property, but it is listed on the 8th page on there. I apologize, I don't have them actually numbered, you gotta count, but. And then that's where the breakdown is of how we calculate the vehicles, equipment, and buildings and contents, it's on that page.
So just and you weren't here, Hope, so you might not remember. You did allude to it a little bit, but so the story the first I've been here. This is my 3rd year doing this.
Okay.
My first year and second year, the story behind the increase, because I first saw this, I was like, as a CFO, wow, this is automatically becoming concerns.
Yes.
The story I heard the last 2 years though was the lawsuit that was lingering was
Class action, right?
well, no, I don't.
Oh,
It wasn't. It was
no? Okay.
it was the wrongful.
Yeah.
Wrongful
incarceration.
incarceration, okay.
And I think it cost $18 million across 3 different counties, and we were on the hook for 6. But MACo, didn't have the reinsurance at the time, but you ended up paying out of the pool, and so it was something that we were catching up on and paying that bill essentially through our premiums to get the pool's reserve built up. It does sound like that's no longer an issue, that is something that's kind of healed. However, due to a scare on reinsurance, potentially losing reinsurance, or having to go back out into the market and get reinsurance again, now you're maintaining high increases.
Not because of that.
Not well to protect your reserve. I thought.
So kind of, but that's not affected. So your particular increase is based off of specifically your loss ratios paired with your number of employees and the increase in total insured property that you have.
Okay.
But I used that as an example to say, if that were to ever happen, we're making sure to where if we had to come out of pocket $4.2 million for our reinsurance, we would make sure that your rate increases did not go up 45, 50, 75% in order to cover that. Our pool is at a place right now to where it would sting significantly if we got hit with that, but your rates are not based off of anything outside of what is going on in the county as a whole and what the actuary is giving us information on to keep the pool safe, but not based off of that necessarily. So you do have the 11% base rate increase that they voted on, but then on top of that, we have 11%. There are some counties that have 0% loss ratios and 2% for liability, 0% for property for the last 3 years. So they had a 5% rate increase. And, because they didn't have an increase in the value of property that we're insuring now. And then they had no losses on top of it. So if you guys had a year like that, then I would come in and say, you guys have 4%, based off of the factors that are put in front of us. But it's not, your rate is not based off of that reinsurance possibility. Our pool is in a safe place, but we want to make sure that it stays in a safe place. So that's where our actuary gives us the multiple options, and then based on the information that our broker gives us, the actuary gives us, that's where our board goes in and says, okay, do we want the lowest place that keeps us safe? Or do we wanna cushion it a little bit in the middle or really cushion it on the high end? They didn't
Right.
choose the high end, they chose right in the middle just to give cushion for claims or anything else.
But I would imagine going into that factor of making whether or not how much risk they want to take.
Yeah,
They're listening to the story of this reinsurance scenario and going, hey, we need to protect our reserve due to this, because like you're saying, we want to make sure that we're not having huge rate increases right after an event like that.
okay,
In order to protect against that rate increase, we're going to increase rates slowly and have a base rate increase of 11%. Yeah, you're gonna have a mod factor based off of our experience versus others. And yeah, it sounds like we're above the mod factor, so we're not getting the 11, we're getting 16.
Yep.
As opposed as there's others that are getting below that. But overall, the whole pool is getting 11% increase. And the committee or the board had to consider risk, and as part of that scenario, the reinsurance risk is definitely, if I was, I would definitely make that part of my equation is
okay,
how am I gonna make it so that the counties don't feel that $4 million hit.
Yeah.
Kind of like seeing what you would have done in the first place when we dealt with those, hindsight 2020, we're dealing with those wrongful incarceration that cost $18 million. What would you have done? You would have built up your reinsurance over time. You would have made sure that it was paid for and mitigated risk that way. And so I think that having an 11% increase it's a risk mitigation that the pool has decided to do. And then so that's your starting point. And you start from there. So we ended up being one of the, I wouldn't say bad actors, but we just
you're not the worst, I promise.
We didn't perform as well as we would have liked, but that's the starting point. Since we were not as good as other counties, we ended up paying more, like 5%, 5.5% more.
Okay,
I think there's probably, and I can't speak necessarily on behalf of MACo, but this is conceptual statement here. Because last year they did talk about the need to refund that pool after paying those large claims. So when these actuaries come out and they talk about what levels of funding you need as a pool to cover the risk exposure, you were talking about moving from red, yellow to almost green.
Yeah.
That part of that 11% likely has to do with helping that pool mechanism get to where they need it to be, and they're trying to not do it in one knee-jerk reaction to get there. It's trying to absorb it over time to build that pool up. So I think that probably part of it is filling that bucket. I mean, like I said, I can't totally say across the board what all those decisions were, but I think you're not wrong on that piece of it. The other question I was going to have in the mix of this is the reinsurance cost. What was the reinsurance cost differential last year versus this year? Did reinsurance take an increase?
I do not know, to be quite honest. I came in July of last year, so I didn't get to see what it was previously. I could find out for you to see what it was.
I think it might answer part of your question to say if reinsurance took a little increase, and they might have been on a 2-year deal or something, I don't know. But if reinsurance took a little increase, then part of your 11% would be your reinsurance aspect as well. Which wouldn't be unreasonable based on the claims picture they showed here and of what's happening in the reinsurance space. But that answer I don't exactly know.
Which I apologize. I think I might have just misunderstood originally, and then as you elaborated, I'm like, okay, I'm following you more. So here, because I originally thought you're like, we're just taking the hit for this, and I was like, well, no, it's not just. But yes, you're correct. So I guess if you were the way that you were looking at it, where you're like, if we're slowly increasing this to cushion for a reckoning with that reinsurance cost, then that could be a possibility that they're, considering in the back of their mind, et cetera. But it is so I mean, but if you guys come in, you know, in the next 2-3 years and are playing the long game and your liability losses are decreasing significantly, then you're going to be part of that factor that goes below. You know, so, but unfortunately, just with where the losses are, that's the biggest thing that it's calculated on, is just what's the risk with this county, and those liability losses are, you know, relatively high. So if you can give me 2 more good years, then that'll be off of there, and then I'll be coming in saying, hey, we got 4%. So, so yeah, we can definitely get you below that 11%, but it's just a matter of, you know, safety training, law enforcement training, safety coordinators, all of the above.
And you said from the how you look at the counties, you're only looking at 3 years. So you're only looking at 21 through 20, 21, 22, 21, 22, 22, 23, and 23, 24.
For
Those are the only loss years you look at when you're underwriting the actual Lewis and Clark County
correct.
as well as other counties.
Yes, so even, so like the fire loss for this year, that was not calculated into this year's premium. It will be on next.
Be one of our properties.
Yes, but your property is
Well,
relatively
won't be bad,
low, so that shouldn't hit you too hard. It's really just the liability claims that are significant. Like I said, I think we counted 24 law enforcement claims alone on liability.
So did you say that, O'Malley and Harris, they are gonna start doing safety trainings, or have they already started doing safety trainings?
So they don't
Or-
specifically do the trainings themselves, but they've been looking at getting grants to send people off for jail commanders, sheriff deputies, etc., sending them off for the trainings. And they've said that they've been fantastic. The reports back of for this one particular training that they came back from, which I think was for jail commanders, but
I would definitely encourage our detention to do that.
yeah, I would reach out to them or let me know and I can reach out to them and have them stop in. I know Brandon brought me over and introduced me to Sheriff Dutton early on. That was a fun meeting, and then got a tour of the facility, etc. So
The other individual, Troy Christensen, is the detention commander.
okay,
For commissioners, just so you know this, we sit on safety committee meetings with the county and we have Montana State Fund folks as well as our what was Payne West Insurance, I almost said it again, Marshall Bennett Agency safety consultants. So Brendan Riley and Sean McDevitt have done some work as well with the county, but Troy just sat with Dan from the state fund and I at the last safety committee meeting and talked about some collaborative efforts that we can pull together to help continue to push that safety aspect. Some portion that's work comp driven, but it's really about tackling issues beyond just workers' compensation. So
there's not much of a differentiation between their work comp and our liability when we're talking in general.
So, but the county does do a lot of work in the safety aspect.
I was supposed to be at another meeting at 4 o'clock. We need to move this along.
I'm wrapped up. Time.
Okay,
Yep.
well, that end of the presentation of MACo annual insurance renewal. Is there any public comment? Seeing none, we are adjourned.
Thank you so much.
You know, we talked about some of the values. I was running a few random pieces of equipment just